Welcome to the CBDC video series, a way for regulators, researchers, and international organizations to learn more about stablecoin technology, design, and policy considerations.
Hello, and welcome to a edition of a topic that we're going to discuss today. It's called Mitigating and Managing Financial Crimes Risk. My name is Ezekiel, and I work at C Labs, and I am joined by my colleague Jay, who is going to help talk to us about some really important issues around mitigating risk. So Jay, if you want to go ahead and give your background real quick, and then we'll jump right into it.
Sure. Thanks, Ezekiel. So for everyone who's watching this, I'm Jay Ramaswamy. I work on risk, regulatory, and compliance matters at C Labs. Prior to coming to C Labs, I was with a couple of financial institutions, Capital One as the head of enterprise risk management, and before that, Bank of America as their head of AML compliance risk management. And before I joined the private sector, I was with the US government, with the Department of Justice for about 10 years in a couple of different roles. Before I left, I was the chief of the asset forfeiture and money laundering section at the department. And before that, an assistant United States attorney in the Southern District of New York and a prosecutor with the cybercrime section in Washington, D.C. And so I joined C Labs roughly in November of last year and have been kind of just becoming engaged in the crypto space and trying to think through some of the complicated risk and compliance problems that we have in the space.
Excellent. Listen, I'm glad you could join us. And so we're going to jump right in. I have a few questions. And also just for those people, anybody who's joining, just wanted to let you know that there is a function at the bottom called Ask a Question. So if anybody has a question that they would like to ask Jay, if we could please ask you to use the Ask a Question function instead of the chat, which is on the side. I mean, feel free if you want to put a message in the chat, that's fine. But any questions we'd just like you to ask using that Ask a Question function. So I think, the first question, just to kind of sort of set the stage, and especially, we're talking about platforms and protocols like Pseudo, which is decentralized and permissionless. I was wondering, maybe just kind of helping people understand what sort of needs does a decentralized and permissionless ledger address?
Yeah, I think that's a great question. It's always the question at the back of people's minds, why do we need these technologies? And I think the reality is that certainly if you're sitting in the United States, we have a deep banking system. A huge part of the population has access to it. We have, in some senses, a lot of individuals in the United States who are overbanked. And so I think that if you're sitting here in the United States, or quite frankly in Western Europe, you'd have that same question. I think once you move out of this that world, you realize that there are huge populations without access to bank accounts in the banking system, and we're not talking about just folks who are on the margins of society, but large populations. And I think this technology has the potential to address a lot of needs in that area. As a practical matter, I think we've also found that, in light of the COVID crisis, that there are gaps in our banking system in the developed economies or in the more developed economies, and I think that we're starting to see that there is a demand for quick, cheap, reliable tools to further financial prosperity, even outside of the banking system. And I think that's the challenge. How do we do that responsibly? How do we meet that demand? And how do we grow the access to financial tools?
Got it. Interesting. So, continuing on with the focus on decentralized systems, obviously one of the big issues is around illicit finance risk. And so, maybe you could give us a sense of, what the attributes of a decentralized system are that raise illicit financial risks, so to this AML. And so maybe you can also, briefly explain to people what AML and KYC and all these things, these alphabet soups of letters are, which can be kind of confusing sometimes.
Yeah, no, I think that's a great place to start. I think people refer to this area in a lot of different ways. You use the term illicit finance. That's something that I think is being increasingly used by both regulators and the private sector. I think historically it's been referred to as sort of financial crimes. It really encompasses a gamut of different illicit activity that are apparent in the financial system. And that is money laundering, which is really just trying to conceal the fact that you're transacting in criminal proceeds. It also tends to encompass terrorist financing, which has some attributes of money laundering, but it's really just funding of activities that are used to, create violence in societies. It tends to also encompass things like fraud. For example, the hacking of identities and the theft of money from financial institutions or elsewhere that are then laundered through different institutions. And it can also encompass corruption and sanctions activity. So, large-scale corruption in most countries involves large sums of money that have to be laundered. It's usually considered criminal activity in most countries, and so that too needs to be managed. And then sanctions, which we've heard a lot about recently, but certain state actors and entities that are on international sanctions lists issued by the UN, the EU. The United States has a very active sanctions program, as many of our listeners may hear, and so ensuring that those entities and individuals and countries can't get access if they're prohibited from doing so through various regimes. And so that whole bubble of activity is generally referred to as historically as financial crimes, illicit finance. And we're seeing an emergence of sort of a convergence, I should say, of activities and programs that are meant to address each of these activities. Used to be siloed, and now they're sort of becoming a single compliance risk management function where you look at the various risks, you try to assess what are the controls in place, and you try to manage that risk or mitigate that risk appropriately.
Got it. And then, so just to briefly get our viewers up to speed. So AML is anti-money laundering?
Anti-money laundering. Yes, I know the alphabet soup can be confusing. So anti-money laundering essentially just refers to programs and policies that are meant to detect and prevent or mitigate the risk that money laundering is happening through a particular institution.
Got it. And then KYC is I didn't know that one. I had to look it up, but the know your customer, right? Which is
know your customer. So one part of many programs and also regulatory requirements is if you are an institution, a centralized institution with an organizational presence and with customers, you should know who those customers are. And if you know that they are criminals, you shouldn't be providing them with services. That's basically the simple way of putting it. And there are sort of little nuances, but that's the basic premise. Got it.
And with the around this KYC and knowing your customer and stuff, can you give us just a sense of, I know people sort of talk about pseudo anonymity. I mean, everyone kind of knows what anonymity is, and that's why people sort of tend to like cash, I guess, because they say it's anonymous. Can you give us a sense of what's meant by sort of pseudo anonymity? Because I know that's a term that people have often used in the industry.
Sure. I think when you think of anonymity, it's nobody really knows what you're doing. Your identity is obscured. Mm-hmm. There are many legitimate reasons that people want to be anonymous, as we're finding out kind of in the world at large. Privacy is a very important value, so I don't want to denigrate that. But in the money laundering context, criminals often like to obscure their identity for not legitimate reasons. What pseudo anonymity is that your identity is linked to an identifier of some sort. So you can tell that there's someone doing a transaction, but that thing in the context of cryptocurrencies is a very long, typically hexadecimal lengthy set of identifiers. Outside of that context, however, the blockchain is interesting because if they're public blockchains, as all cryptocurrencies, all sort of classical cryptocurrencies are, you can see the transactions, you can see the amount volumes. You just don't know who that individual is. And so I think pseudonymity is meant to refer to the fact that while the identity of the person isn't known, their activity can be seen and can be analyzed in various ways. And I think it's that distinction between the transaction transparency versus the identity of the individual.
Got it. Excellent. Listen, so I guess, let's jump into like kind of the sort of the main issues here, and just to get your thoughts on like what are the risks that you worry about, specifically, and maybe broadly. I mean, then we can get into them more specifically, but just kind of giving a sense of like, what are the, I mean, obviously there are risks in this field. Certainly, regulators are very concerned about a number of things, and maybe you could just kind of help our audience, kind of sort of think about and understand what some of these risks are that you.
Yeah, no, absolutely. And I think the background is really helpful to give just so that people get a context for what we're talking about here. So look, the reality is that these kinds of financial crimes and illicit financial activity occur in the world at large. And the reality is that they are a part and parcel of what we've come to see as the global economy. They're an underworld and an underbelly, but a fairly sophisticated set of relationships that exist in parallel to the financial system. So I think if you talk to law enforcement and if you talk to regulators, they understand that no single individual or institution is going to be able to root this out, root and branch. It's really a question of risk management. How do you understand the context of how you're operating and manage and mitigate and limit the risks to a reasonable degree? And that really depends on the specific attributes of the entity or the product, or in this case, a platform that we're talking about. And so I think when you think about cryptocurrencies, and this is nothing new, you'll see this if you read any of the blockchain analytic reports that are out there by companies like Elliptic or CipherTrace or Chainalysis, you'll see the same analysis. I think the Rand Corporation recently produced something yesterday or this week around a particular cryptocurrency known as Zcash, where it goes through these very, very same attributes. And they're worth reading just to get some background and understanding. But they have to do with, I think, a couple of ways that these platforms tend to be constructed. First, they're permissionless and decentralized. And what that means is that the platforms themselves are run on a distributed set of computers. Unlike when you have a company that has a server and a presence and an organization around it, these are really run by a distributed set of network operators who download software, which is usually open source, and they run the network. And so there isn't a single identifiable organization behind these. And as I said, there are real reasons for that. There are reasons why this is a resilient system. There are reasons why this is a way of creating a networked set of relationships that actually have proven to be historically pretty robust. If you look at sort of even going back to Bitcoin, the systems themselves from a computer science perspective tend to be fairly robust. But what that means is that, if I'm a financial institution, I have a presence and I have customers, and I can know those customers. When you're a decentralized system, that isn't the case. But I think the way to think about this, and this will get when we talk about mitigating some of these risks, when you think about a platform, it really is just that. It's a platform, and then things are built on top of it. Applications are built on top of it. Uses are built on top of it. And so any institution that uses those platforms to engage in various kinds of activity falls under various laws, rules, and regulations around the globe. And I think there's an active debate about this. So to be fair, I think there's an active debate about the platform versus kind of things built on the platform. But I think it's important to recognize that decentralization raises that debate. And the question is, at the platform level, what are the risks, and how do you mitigate those risks? They're permissionless, meaning that typically, if you want to become an operator of this network, you download software and you meet certain requirements, and then you are part of it. If you're a user, the thing that these permit is it permits the self-custodying of assets that are transferred over. So you could theoretically, if you had sufficient knowledge, do this stuff yourself, and through pseudo anonymity, kind of engage in largely anonymous transactions. If you choose to do it through an institution that has KYC, et cetera, then obviously that panoply of things exists. As an internet-based system, it's international. And so you're exposed to kind of risks around the globe. It's very hard to localize these kinds of platforms because they are global. The users are global, the network operators are global. And so there's that level of things. And then I think finally, you have to sort of start thinking around what are some of the other risk factors? And I think these are more nuanced. One of them is adoption, right? Because criminals have lots of ways of laundering money today. And so how broadly a particular asset or cryptocurrency is available will determine whether it's useful to a criminal or not. And so the broader and more adopted something is, the more useful it becomes and the more likely somebody is to use it. And then simple things like the ability to exchange into fiat currency. If you talk to law enforcement, if you talk to regulators, they recognize that, at least in today's economy, cryptocurrency can't be used for things yet. You can't just go to a store and buy with it. That may change in the future. You've got to use fiat currency to do that. So dollars, euros, whatever. And so the ease of ability to exchange into those currencies that can be used in the real economy is another risk factor. The easier it is to do that kind of exchange, the higher the risk of the particular platform or the particular cryptocurrency. So those are kind of what I would call the risk factors that generally one looks to and thinks about in the context of decentralized cryptocurrency networks.
Got it. And sort of a quick side question on this. I mean, so it's my understanding, I mean, especially you were talking about, exchanging this cryptocurrency for fiat. I mean, it's my understanding, at least right now, I mean, that would sort of happen in a setting, perhaps like on an exchange or someplace where KYC compliance rules are probably going to take into effect. Is that correct? The places where you would actually be able to, I know people refer to them as sort of on and off ramps, where you can then, get onto the network or get off the network by, exchanging for fiat or crypto or whatever. So I would imagine that on those places, people, if they want to get off the network, right, and exchange their cryptocurrency for fiat, they would have to sort of do that at an entity or a platform that requires some information.
And that's typically the case. Certainly in the world we live in today, there's an emerging risk, and I think people are keeping a close eye on this. But as I mentioned before, there's the ability to do peer-to-peer transactions, but it requires a level of technical sophistication that's not necessarily that easy for folks to use. You can acquire that knowledge, and you can certainly hire for that knowledge. But the reality is that if you just look at the transaction flows, they're happening through centralized exchanges. To your point, through exchanges that have obligations. Whether they comply with them, I think, is the question, but that have those obligations and should at least be collecting that information. I think the other thing to recognize in this space, and it's closely tied to the question of adoption, there's an institutional ecosystem that is developing, that needs to develop more around how do you hold these assets, how do you transfer them, how do you transmit them, and if you want, sure, you could download open source code and you can do this all by yourself, but it's not that easy and it's complicated. And certain platforms, certainly the one that we're both working on, Cello through C Labs, is a community-led development, but it's one where hopefully the ease of use will be better. But there's still integration that has to happen with wallets, with other ways to hold this stuff. And if you self-custody, you are opening yourself up to potential risks there too. So a lot of people tend to default to, hey, I'd rather have this be through an institution or anywhere else. And so as a practical matter, when you look at the volume of flows these days, what you've pointed out is correct. That centralized institutions tend to have the bulk of the activity, even if the platform itself is decentralized.
Got it. Okay. Well, so now we sort of have a better sense of the risks that are, potentially there for decentralized and permissionless platforms. I guess obviously the biggest question then is, well, how do we manage those risks and how do we mitigate them? And so maybe you can kind of walk us through some of the some of the things about if there are controls that we should consider, if there are governance issues. I mean, just how do we kind of mitigate these? Because I'm sure that's exactly what regulators and authorities are interested in, for sure.
That's absolutely right. And look, I mean, I think what everybody recognizes is that when you move to a model which is decentralized, there are definitely challenges of the type that I mentioned. Those risks are real risks, and regulators, have an important job in trying to think through how do you appropriately see if someone is mitigating risk appropriately according to their obligations. And I think I would break it down into a couple of buckets. One is sort of governance questions at the protocol level, and I'll explain what that means in a second. The other are sort of controls that can be put into place, and that can happen at the sort of platform level to a certain extent, but it can also happen within specific wallets, products, exchanges that are built on top of that. And so I would break it down to those three things. I think one of the most important things, and I would lead off with this because you actually see this when you leave cryptocurrency and go to the formal financial, the legacy financial system. People talk a lot about culture, right? Culture at the top. I think that's a really important question of governance. And so when you're sort of creating a new community, a new cryptocurrency, and we face this at Celo, how do you create a culture where those who are going to use and develop on this platform have a sensitivity to the kinds of issues we're talking about? And I'm glad I love to have forums like this to sort of help foster that culture. And I think that's really important because if you have that risk sensitivity, you're going to be more likely to engage in a way that's proactive and that responsibly manages these risks. So I would put that at the top of anything. Fostering a community that respects and understands the reasons for it and sees it as one of the competing values we have to map to and part of the mission. The second is, there aren't centralized organizations in a truly decentralized platform, but there are ways for particular users who share a mission on the platform to play an influential role. And I think of this as if you look at the way, for example, our platform is organized, there's a very important organization called the Alliance for Prosperity. And that organization consists of people who are mission aligned with Celo's mission to further financial prosperity. And I think within that context, you can think of organizations that can engage in sharing of best practices, sharing of risk information. If a particular developer or node is seeing something, being able to share that. One of the really neat things about blockchain, which isn't true of the traditional financial system, and is a really important control to mitigate the risk, is that the transactions that I mentioned before are transparent. So whereas to understand transaction flows and behavior in a financial institution, you have to have access to their particular data, anybody who's on the blockchain can actually look and see what the risks are, what the risky wallets are, what the risky exchanges are, regardless of whether they have a direct relationship. And that allows for a degree of shared analytics and information sharing and developing a community of knowledge that is really not possible in traditional financial systems. And that's really important to foster mechanisms at the platform level for that sharing of information, for the clear communication, so that action can be taken at that level. And so I think that's really important to think through, or what are the touch points at the platform level of influential sort of groups of folks that can influence protocol changes in the future if necessary, or can inform sharing of information and just managing the risk collectively, which I think is a really important thing. So that I put in sort of the governance bucket. Mm-hmm. And then you get to sort of the controls, and typically the kinds of things you're going to think through are at the protocol level. There's something, there's an international principle now that has been promulgated by the Financial Action Task Force, an intergovernmental body that considers these, and that member states abide by. It was something that the U.S. pioneered, I think, a couple of decades ago, called the travel rule, which is this notion that if you are acting on behalf of customers, the information about the identity of those customers has to travel with any transaction, so that the receiving institution can perform their obligations on it. So institutions need to be able to communicate. And one of the things that's important is if you're building a decentralized protocol, having some sort of capacity in there to share that messaging information secure. It could be as simple as a messaging field. Now, there's also a standard that's being developed that may put this, in a sense, as an unnecessary need. But I think it's good to have that just in case an institution or institutions don't have an out-of-the-box solution to it. It provides a way for those who are building on the system to do so responsibly. So I would say that that's one thing that can be done at the protocol level. At the protocol level too, I think, as I was mentioning, this notion of blockchain analytics, any individual participant, entity that's participating can do analytics for the chain as a whole. And so that's really powerful. It means that you can do protocol level monitoring and share that information. And so that's kind of a combined protocol / application level type of activity, but I would sort of say that that's really important. Transaction limits is something that at the application level you can consider, which is, hey, should we think about, if we're really trying to address an issue of those who don't have access to financial systems, should we consider, and there are good reasons why you might not want to, but can we consider transaction limits, daily transaction limits, to make sure that this is for modest uses, not for large scale movement of money. And then there's a sort of compendium of things around that come out of blockchain analytics and monitoring, which is cooperating and responding to law enforcement requests. So where law enforcement has requests and you have information, sharing those requests, proactively working when you see criminal activity to help identifying those threats, and filing, and this can be voluntary filing as well, of things like suspicious transaction reports, suspicious activity reports that most jurisdictions have. And that allows law enforcement to see some of what you're seeing. There are very strict standards for keeping that information confidential. There are strict standards about how you get to that level so that you're not throwing in a lot of innocent activity. But it's an art, it's an art and science. And I think being able to do that in a responsible way helps police, if you will, the activity, and make sure that it's being used for legitimate, not illegit purposes of the type that I mentioned before.
Got it. Excellent. Obviously, regulators are such a big part of, especially what, you and I do. And I know I didn't really sort of mention at the outset, but as you know, I focus on our work with central banks and, how they should think about our systems, from a monetary policy perspective, and what kind of ramifications, a digital currency, whether it's a central bank digital currency or a stable coin or a global stable coin, might have on the monetary policy side of it. But I'm wondering, obviously clearly here we're talking about risk. And so I'm curious, how should regulators feel about systems from a perspective of risk and competition and privacy, for example?
Yeah, look, I think these are all competing values, right? Certainly in the project we work on, there's a desire to make sure that everybody shares in global prosperity and that everybody has access to finance. And that's a very important value. There are also important values around making sure this stuff isn't misused. There are important values around making sure that in the appropriate circumstances, people can preserve some modicum of privacy, so the whole world doesn't know what you're doing. That risk that may be outweighed in certain circumstances, certainly as the transaction volumes and other things become bigger for certain institutions, then you have to think through carefully those implications. But all of these are really important values. And I think the one thing the regulators have really emphasized and has been a core tenet of illicit finance or financial crimes risk management is this notion of a risk-based approach. Do you understand the risks that you're facing? and can you mitigate those risks? It's not a one size fits all, and that's sort of in all the guidance that you hear. And I think that implicit in that is you can't eliminate risk. The only way to eliminate risk is to stop doing things, and nobody wants that to happen. And so how do you manage it at a reasonable level? And I think that's to have that conversation around what is the real adoptions that we're talking about in the various platforms that exist, and can we calibrate the measures that are necessary for particular platforms based on that adoption and based on the likely patterns. So I think that's one thing, really understanding what it means to manage risk and mitigate risk, not to eliminate behavior, which I think is just harder to do. And I think that's an active debate that is worth having. Mm-hmm. The second thing is, I know that there's some feeling that maybe certain activities should not be allowed, and I think that's a debate worth having. But I think the reality is that a lot of this stuff is just technology. Very, very hard to prevent it from coming out. A lot of the early things were really just open source code and papers. They're really just ways of expressing ideas and doing things. And so I think to be able to stop that is going to be difficult. You can put regulations around the usage of those things, but I think at the end of the day, it's better to have these things actively debated, to think through the right level of regulation, as we're thinking through in the internet, between the actual internet itself versus things built on the internet. Similarly, the things on the platform level versus on top that are built, applications on top. And we do that because if we don't, these technologies could potentially go underground, which wouldn't be great for anybody. And I think it's really important to have that dialogue and that those conversations around it. And then, as I said before, I think it is important on some level to think through the privacy implications of what we're doing. I think there are a lot of different competing things here. Nobody wants criminals to be transacting anonymously, and I don't think anybody wants that. But if you're just an individual that has low value transactions that isn't really raising a high money laundering risk, can we think about differential levels of anonymity for those? If you're have large money flows out of haven jurisdictions or using shell corporations, maybe that level of privacy is not warranted. But if you're doing simple transactions on the consumer level in a low risk area, maybe we should think about it. And so trying to balance and compete the various risks in these areas. And I don't mean to even suggest that this is an easy thing to do. I think these are very, very difficult concepts. But this is a new area and it's growing. And I think that it would be appropriate to look at this as areas where there are a lot of emerging risks. But if you read the kind of literature that's out there talking about what's actually happening, I think it's very clear that we're in an early stage of adoption of most of these technologies, and it's worth letting things grow and organically grow, and monitoring them and understanding risks in this space before that, just to manage risk accordingly in the space. So I hope that answers your question. But,
yeah, no, I think that was great. I mean, this is a very important question, and a very important topic. And so I think, obviously this is going to be something that we're going to continue to talk about, and we're going to continue to flesh out, and hopefully, we can start to have dialogues and bringing in, regulators and hearing from them as well. So I do thank you so much for your time today to kind of give this overview of the risks associated with, decentralized and permissionless systems. And hopefully you'll come back and we can talk about some other topics, because I know that, this is very important for central banks to think about, for other regulators to think about. There's certainly a growing industry of, technology around regulation, right? There's this whole new concept of reg tech and soup tech, which I'm assuming stands for supervisory technology. The BIS has done some really great work on looking at that. And so while there are sort of risks associated with it, there are also new and innovative ways of actually doing, being more efficient and effective at regulation. That also might level, that might level the playing field for some, because I can imagine, and you had this in your previous jobs, right, of trying to comply with regulations, which, every, upstanding company wants to make sure they do. But I can imagine, they can be difficult to comply with everything, just to understand them, first and foremost. And so there's going to be a really interesting conversation around, how technology can actually help from that perspective.
Yeah, and if I could just make one parting thought, I know that we're a little over time, so I do want to make sure we stay on time. But we focused the conversation a lot on the sort of risk side of the equation, a little bit on the controls. The one thing that I really want people to understand is that the technology itself has some really fabulous attributes in terms of risk mitigation. I think that one of the things that you notice if you're coming from the way that things are regulated in financial services, as I have, companies spend an awful lot of time on due diligence upfront. And monitoring is obviously important as well, but it produces a lot of data. And some of that is absolutely necessary. A lot of it is. And the principles themselves are absolutely crucial. What this technology does allow, and I think that people are starting to see the value of this, is the notion of blockchain analytics is something that's really different in this space. And by that, what I mean is, because of the transparent nature of the blockchain, you have independent entities that are able to look through and understand and aggregate risks and data on a platform level that might allow you to do something as we think through kind of what future regulation could look for. And really just throwing it out there, where we could start looking for patterns of behavior that really are indicative of criminal behavior of types. There are typologies out there, but I think this allows you to do that. And then focus our efforts on the detection and prevention of those in a much more efficient way. And so in the past, I think the way you think about anti-money laundering is to look first at sort of identity and collecting as much of that information as you can. That raises huge cybersecurity and identity theft risks. And then we go to monitoring as sort of an added benefit. And I wonder if you can reverse that polarity in a future world where really what you're doing is looking for anomalous behavior and then focusing your guns on identifying those folks who have those attributes. And I don't mean to say this is an easy question or easy way of thinking about it, but I do think that reversing that polarity a little bit may lead to more efficient solutions, and that this technology allows us to do it in a way, because of the transparent nature of the blockchain, that is a little bit more difficult to conceive of in traditional finance. But it's an open thought, and I think this is a conversation. I just thought it would be worth throwing it out there for future discussion. And
definitely a topic for future conversation, because like you said, we're running out of time, but I wanted to thank you for taking time to talk to us, and we'll definitely be talking more about it. It's a topic not only for regulators, but just for consumers alike. Everyone wants to make sure that they're safe, and they want to make sure that they're not, behaving in any criminal activity. And so, finding ways to mitigate those risks, finding ways to make it easy for people is important. So I just want to say thank you for taking time, and we'll hopefully get you back on again.
Great. Thank you.
So I think with that, we're going to end it. But it was great. Hopefully everyone enjoyed this, and please feel free to reach out. You can find both Jay and I at C Labs. If you go to cello.org, you can find out more information on the platform that we're working on, and we'd love to reach out and talk to you. So thank you.